Good evening, everyone. Today we're going to be discussing problem 1 for the culminating output by group, together with John Walter Ventura and Aref Raji Lomondaya. I, Andro Bersales, will be presenting to you tonight inventories. So inventories are assets held for sale in the ordinary course of the business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services, measured at lower cost and net realizable value on an item-to-item basis. Inventories are also encompass finished goods, produced, goods in process, and materials and supplies awaiting use in the production process. Goods includable in inventory. As a rule, all goods to which the entity has title shall be included in the inventory regardless of classification. The phrase passing of title is a legal language which means the point of time at which ownership changes. So the legal test is if the entity is the owner of the goods to be inventoried, the goods are includable in the inventory account. If the entity is not, then the goods are not includable in the inventory account. However, the only exception to such rule would be installment contracts, where it is an accepted accounting procedure to record the installment sale as a regular sale, involving deferred income on the part of the seller and as a regular purchase on the part of the buyer. So the owner of goods in transit. Depending on whether the terms are FOB destination and FOB shipping, FOB meaning free on board. Under FOB destination, ownership of goods purchased is transferred only upon receipt of the actual goods by the buyer at the point of destination. Thus, under FOB destination, goods in transit are still the property of the seller. The seller shall also be responsible for freight and other expenses up to the point of destination. Under FOB shipping point, ownership is transferred upon shipment of the goods. Therefore, goods in transit would then be property of the buyer. Buyer shall be responsible for freight and other expenses from the point of shipment to the point of destination. Procedure is expedient and no material misstatements occur in the financial statements because title usually passes in the same period. Okay, now let's proceed to the problem itself.
Okay, now let's proceed to problem 1. You were engaged by Asingan Corporation for the audit of the company's financial statements for the year ended December 31, 2021. The company is engaged in the wholesale business and makes all sales at 25% over cost. So, we have 4 questions allotted to us. The first is we have to find the sales for the year ended December 31, 2021, the purchases, the accounts receivable, and the inventory balances. Okay, now let's proceed to question numbers 1 and 3, which are sales and accounts receivable. Let's start by, okay, let's label this sales for the year ending December 31, 2021. Okay, we are provided by the given problem a year-end balance for the sales of 8,295,000. Now, according to the additional information, you observed the physical inventory of goods in the warehouse on December 31 and were satisfied that it was properly taken. When performing sales and purchases cut-off tests, you found that at December 31, the last receiving report which had been used was number 2063 and that no shipments had been made on any sales invoices whose number is larger than number 868. Now we adjust the unadjusted balance with goods not shipped at year end. So it was provided that goods that are higher than sales invoice number 868 were not shipped at year end. So we add the values of said sales invoices. So sales invoice higher than 868, which is 869, 870, and 871. Okay, these are the values of our sales invoices that were not shipped at year end. So if they were not shipped, they were retained in the inventory. Thus, it is not included in the sales for the year ending December 31. So the sum for the three values is 195,000 pesos. Letter B. On the evening of December 31, there were two trucks outside of the company's warehouse. Truck number MGM 357 was loaded and sealed on December 31 but left the company premises on January 2. This order was sold for 150,000 per sales invoice number 868. So this shipment of goods should not be included in the sales balance because it is yet to be shipped on December 31 and it only left the company premise on January 2 of the following year. So it should be kept as inventory because no sale has yet been made. The sales balance or the closing entry here, which is 8,295,000, did not include the sales invoice number 868. So we cannot deduct it because it is already unincluded in the unadjusted balance of the sales. So we disregard this additional information. Okay, now let's proceed. Letter C. Let's see if we can find some additional information. Temporarily stranded at December 31 were two delivery trucks en route to ABC Trading Corporation. ABC received the goods, which were sold on sales invoice number 866, terms FOB destination the next day. So, this sales invoice number 866 was goods that were shipped to customer FOB destination. So the rule for FOB destination is that it is still considered your inventory if it is as it is in transit. So it should be recognized as inventory, thus it should be deducted to the unadjusted sales balance. So now let's go back to our solving. Okay, now let's continue with our solving. We deduct goods in transit to customer. Sales invoice number 866. So the value is 225,000. Now solve for the adjusted balance at year end. Let's see, December 31. So 8,295,000, we deduct both of these values and we end up with a sum of 7,875,000, which is letter C for number 1, sales for the year ended December 31, 2021. Okay, now let's proceed to solving for accounts receivable as of December 31, 2021. So the unadjusted balance at year end for accounts receivable is 750,000. So now let's input accounts number 3. Number 3, accounts receivable at year end, December 31, 2021. So the unadjusted balance of the accounts receivable account is 750,000 as provided by the problem. So the technicality of this, of finding both the accounts receivable and sales, is that deduction to the unadjusted balance of the sales is the same as the deduction to the accounts receivable because there is a one-to-one effect on the accounts receivable account to the sales. So it has the same effect, and I will show you through adjusting entries later why this has the same effect. And now let's copy this, the same values. That's a one-to-one effect. And also the goods in transit. Both the goods not shipped at year end and the goods in transit to customer. The only difference between these are the beginning and the ending balances. So solve for the adjusted balance, which is the sum of our values. Adjusted balance for December 31. Okay, so 750,000 minus 195,000 is 555,000, and 555,000 minus 225,000 is 330,000. Okay, so the adjusted balance for December 31, 2021 for the accounts receivable account is 330,000. Okay. 330,000. So we have an ending balance of 330,000. As we can see in the questions. Question number 3, accounts receivable as of December 31, 2021 is letter B, 330,000. So now we provide for the following adjusting entries. So the adjusting entries for goods that were not shipped at year end, which were the sales invoices of numbers 869 to 871. So we adjust the accounts, both accounts receivable and sales. There is a one-to-one effect because sales is debited, while accounts receivable is credited when you reverse the entry for the year end, when you adjust the accounts. Okay, so goods not shipped at year end. So let's start with that. Goods not shipped. Goods not shipped at year end. Okay, we have sales. We debit the values of the 3 sales invoices that were not shipped at year end, which had a total value of 195,000. So we debit sales by 195,000. And we credit accounts receivable. Accounts receivable by the same value, because as sales are deducted to the accounts, the following accounts receivable is also deducted because it has the same effect as to the accounts receivable, the deduction of sales. Now let's provide for the goods that were in transit to customer, that were shipped FOB destination. So we will be doing the same adjusting process as the goods not shipped at year end, because it is a deduction to sales and also a deduction to accounts receivable. So sales were debited for 225,000 to the accounts of sales and a credit to the accounts receivable. So we have 225,000 debit to sales and a credit to accounts receivable for the same amount, 125,000. So that is how there is a one-to-one effect as to sales and accounts receivable when sales is adjusted. Now let's proceed to the purchases and the inventory as of year end.
So now let us proceed to the purchases for the year ended December 31, 2021. Here we have our unadjusted ending balance of 4.5 million. Now, when performing sales and purchases cutoff tests, you found that at December 31, the last receiving report which had been used was receiving report number 2063, which is our last recorded report here. Then, included in the warehouse physical inventory at December 31 were goods which had been purchased and received on receiving report number 2060, but for which the invoice was not received until the following year. Cost was 27,000. We can notice that receiving report number 2060 is not included in the purchases ending balance. We must include it since we must recognize purchases as we recognize inventory. considering how it was already included in the physical inventory count. So here we must add the goods received but not yet recorded. Receiving report number 2060 with a cost of 27,000. Then, on the evening of December 31, there were two trucks outside of the company's warehouse. Truck number XXX888 was unloaded on January 2 of the following year and received on receiving report number 2063. The freight was paid by the vendor. Since receiving report number 2063 was already recorded in the ending balance here, we do not need to recognize it again as purchases. It is only an issue for the inventory balance. Then lastly, en route to the client on December 31 was a truckload of goods, which was received on receiving report number 2064. The goods were shipped FOB destination, and freight of 2,000 pesos was paid by the client. However, the freight was deducted from the purchase price of 800,000. Since the purchase was shipped FOB destination, we must only recognize it as a purchase and also as an inventory upon receipt of the goods by the buyer at the point of destination. And since it is shipped FOB destination, we must not capitalize the freight in cost of 2,000 that the client paid as part of purchases. So our adjusted balance for the purchases for the year December 31, 2021 would be 4.5 million plus 27,000, which is 4,527,000. So our answer here would be letter B. Now, since the ending balance of the accounts payable account was also mentioned, let us also solve for the adjusted balance of the accounts payable. Here we have an unadjusted balance of 600,000. Then since we added receiving report number 2060 as an adjustment debited to purchases, it must also have a corresponding credit to accounts payable. So here we add the goods received but not recorded. Receiving report number 2060, 27,000. So our adjusted balance for the accounts payable would be 600,000 plus 27,000, which should be 627,000. Thus, our adjusting entry here would be to adjust the goods received but not recorded with a debit to purchases of 27,000 and a corresponding credit to accounts payable of 27,000. Then we proceed to the inventory.
So let's move on to inventory as of December 31, 2021. Let's start with the unadjusted inventory balance, which is 900,000 pesos. Let's make some adjustments based on the additional information. So first, receiving report number 2060 costing 27,000 will not anymore be added since it was already included in the physical inventory count as of December 31, 2021. So next, as of December 31, there were two trucks carrying inventory outside the company's warehouse, one of which is truck number XXX888, which carries purchase goods recorded in receiving report number 2063, costing 96,000. So since the goods were paid by the vendor, it indicates that this is purchased FOB destination, where the ownership of goods were transferred to a single corporation upon the receipt of goods, regardless if the goods were already unloaded or not. So let's add the purchase is 96,000. Not included in inventory. 26,000. Report number 2063. So next, stock number MGM357, which carries sold goods for 150,000 with sales invoice number 868. It was not indicated whether it was sold as FOB destination or FOB shipping point, but since it is still not shipped as of December 31, the owners still have control of the goods, so it should be added or included in the December 31 inventory count. So let's add goods not yet shipped. This invoice number. So note that the sales invoice 868 values at 150,000 and all sales are 25% over cost. So we must divide 150,000 by 125% to get the cost of goods sold, which is divided by 120, which is 120,000. Next, temporarily stranded at December 31 were two trucks en route to ABC Trading Corporation. ABC received the goods which were sold on sales invoice number 866, terms FOB destination. So the goods was shipped FOB destination and ownership will be transferred only to ABC Trading upon the receipt of goods. So it must be included to Asingan Corporation in December 31 inventory count. So still added or included in the December 31 inventory count. Goods in transit. So same as sales invoice number 868. Sales invoice number 866 should also be divided by 125% to get the cost of goods sold. So 125,000, which is the value of this invoice 866, divided by 1.25 or 1.25,000 equals to 180,000. So lastly, en route to client on December 31 was truckload of goods, which was received on receiving report number 2064. The goods were shipped FOB destination and freight of 2,000 was paid by the client. So this purchase will not be included or added to December 31 inventory since it was purchased in FOB destination and ownership will be transferred to a Singan Corporation only upon receipt of goods. So the total of the adjusted inventory will be 1,296,000. So in question, it is letter C. So to make the adjusting entries, first for to adjust receiving report number 2063. It has debit inventory end 96,000 and credit income summary 96,000. To adjust sales invoice number 868, debit inventory 120,000 and credit income summary 120,000. Lastly, to adjust sales invoice number 866, debit inventory 180,000, credit income summary 180,000. So yeah, that concludes our problem regarding the inventories, which was governed by past 2. Thank you and stay tuned for our next video.